Hello and welcome to the Control Your Cash podcast. I'm your host, Olivia Kirk.
And I'm your co-host, Tim Urich.
Today we have a repeat guest with us, Bill Rinaldi. Bill, welcome back.
Thank you, Olivia. It was an honor to be here the first time, and it's even more of an honor to be invited back. So thank you very much.
Absolutely, we're happy to have you.
So, Bill, a lot going on out there in the estate planning world, and obviously, uh, last week's election probably changes things, or maybe moves things a little bit. But one of the things that, in anticipation of the Trump tax cuts sunsetting in 2025, there was a lot of, uh, I would say, positioning in the financial services industry for the fact that it seemed that the estate tax um, exemption was probably going to go down starting in 2026. And, with all of that noise that was happening at the time, I I couldn't help but thinking about your dad, Frank Rinaldi.
Oh,
And
yeah.
your dad was an iconic figure in the financial services industry when I came in to the industry in 1985. And what I'd like to do is, if you can, let's talk about your dad a little bit.
I grew up in his house, and we became eventually. I worked for him and became his business partner in later years. But I'll say this about him: I don't think anything really came easy to him, and he became one of the intellectual leaders in the estate planning business, which was kind of amazing when you consider that he really was basically a shy and quiet kind of guy. But he had to overcome so much in his life to get to where he got. I know he lost his own father at a young age, and I think that really brought out this determination in him that he used for the rest of his life. For example, my dad was he was average size. He was about 5'10", and yet he went on to become a Division One college football player, and in fact, an offensive lineman in Division One college football. He was outsized by pretty much everybody on the whole team. He had running backs who were bigger than he was, and yet he played college football at that level because that's the kind of determination he had. And I'll tell you one quick story involving me when I was 8 years old. I like every kid growing up in that era, at my age, I loved to play baseball, and I loved going out and playing Little League baseball. And I remember there was this one game where the bases were loaded, and I was playing center field. Bases were loaded, and we were up by 1 run with 2 outs, and the ball was hit to me, and it was a base hit. I picked it up. I went to throw the ball, and I saw that the winning run was looked like they were going to try and score. And I reared back and threw the ball as hard as I possibly could. I threw the ball so hard that I broke my arm in the process.
Oh,
Yeah, and I could hear it break. It was awful. And to make matters worse, the catcher dropped the ball, and we ended up losing the game. So I was coming back in. I was coming back in, and I was crying, and I was holding my arm. And I remember the shortstop said to me, "It's okay, Billy. You don't need to cry. You made a good throw." But he didn't understand that I had broken my arm. And so I went to the doctor the next day after going to the hospital, and he looked at the X-rays, and I had this other problem with my arm. He concluded by telling me that my baseball career was over. I couldn't play baseball anymore at 8 years old, and I was devastated. And a couple of days later, after that, my dad came to me, and he said, I talked to the doctor. How about if you learn how to play baseball left-handed? And I said, what? He said, play baseball left-handed. So he took me outside, and I started throwing the ball left-handed. And after about 10 minutes or so, I said, I can't do this. There's no way I can do it. But he insisted that I stick with it. So I spent that entire summer learning how to play baseball, throwing the ball left-handed. And I came back the following year, the next 2 years, and played as a left-handed outfielder, left-handed center fielder on my little league team. And actually, there was one game the second year where I ended up saving the game by making this unbelievable catch at the end of the game. So I learned a valuable lesson about determination at that point from my dad, and all that I continue learning from him all the way through the rest of his life, including the time when we were in business together. So it
Well,
was,
that's a great story, and you know, that was so creative just to have him think that way. You know what I
yeah,
mean?
that was one of his basic business principles too, was that there's always a creative way to find a solution to a problem you have. In fact, I this also applied to me last week. I'll tell you another quick story, if you don't mind. I was meeting this new group of people last Friday, and it was a Zoom meeting, an initial meeting, and I really wanted to make a good impression on these people. Uh, and after the meeting ended, I thought to myself, boy, you were really terrible. You know that you really laid an egg. You were supposed to talk to them about all these ways you could help them solve their problems, and instead you ended up talking all about yourself, and you really blew it. But then I remembered something else my dad had taught me, and he said this is a business principle I learned much later on, which is that it's better to have a bad meeting with good follow-up than a good meeting with bad follow-up.
Oh wow.
So, so you better believe I've already followed up with these people, and we'll see what happens. But that was another very valuable lesson I learned from him. So,
Wow, that's awesome. So I don't know if we want to venture into this, but especially now that with President Trump winning, there's probably a better probability that the estate tax exemption will stay where it is.
mm.
Is that a fair estimate, Bill?
I think all bets are off right now, Tim. I mean,
Yeah.
up until the point of the election, for the last few years up until that point, in the estate planning industry, the the base assumption was always going to be that the Tax Cuts and Jobs Act of 2017, they were going to let that expire, which meant not just the estate tax reduction or the estate tax enhanced exemption, but also the income tax cuts as well. And the reason they always thought that was because when it got to this point, at the time the law was set to expire, there was going to be some sort of divided government. You know, the Democrats would hold one house of Congress, the Republicans would hold the other, Democrats would hold the White House, or vice versa. But there was always going to be that kind of balance in there to prevent that. It was never thought that the Republicans would hold all three houses, you know, the White House, the House, and the Senate. Um, Now that that's the case, we'll see what happens. I think there's at least a halfway decent chance that some of the provisions are going to be renewed. I don't know about all of them, but they're going to have to get to work and they're going to have to get into committees and whatnot and try to figure out what to do. I think there's a good chance that the estate tax, as you mentioned, the exemption right now is $13.6 million per person. So what that means is that any married couple who has less than $27 million doesn't have to worry about the estate tax. If that's allowed to expire, then that amount gets cut in half back to where it was back when we used to do our estate planning work to a much lower figure than that. Now, even that lower figure is still not going to affect that many people, right? There aren't that many people with 16 or $13.6 million dollars as a married couple. But there are going to be more people affected if that rule changes. So we'll see what happens. I think there's a halfway decent chance that now, at least, that they're going to extend that law and keep it at that higher amount. But we'll see.
Yeah, and even though there aren't a lot of people, for those people who do fall into that category, it's a big deal for them, right? Because the state tax is what 40% of whatever's there, the government's going to get, right? So,
Yeah.
if you fall in that category, or don't fall in the category currently and are going to, that planning is important, and figuring out when and whether it's going to impact you is kind of a big deal monetarily for your estate.
Yeah, and if it does expire, then a lot of the older concepts that my dad used to talk about all the time are going to be coming back into vogue. Uh, so we'll see what happens. It could go either way, but you're right, Olivia, in the fact that the estate tax rate is 40%. That's pretty steep. I mean, that's going to get your attention. You could lose 40% of your assets in one shot.
Well,
So
it's especially troubling, being a steep tax, and it's progressive as well, right? So the larger your estate, the higher the rate.
not really. No, I mean,
No,
I mean, it is. Well, yeah, it is. The maximum is 40%, but we always just kind of assume that that's where most people are going to be at that 40%.
right.
Right, right.
But here's the thing that I have trouble with on the estate tax. We're already taxed on our income.
Hmm.
And then with that after tax money, if we, build a business or are successful investing or a successful at saving money, what have you, and then we build a significant estate, then they come back and get you again.
Hmm.
So it's like it's almost like there's no incentive to be successful financially.
Yeah, I mean, I think the government's answer to that is that what they're taxing is your right to give your property to whoever you want, and that's, I I tend to agree with you, Tim, on that. I think, and the other thing I would also point out besides that is that if you look at where the government gets its money, it's primarily income taxes and payroll taxes. This is like a third step cousin when you talk about the estate tax. In other words, it doesn't generate that a big of a percentage of their overall revenue. So they wouldn't be giving up that much to extend those extension that those extended exemption amounts. So
But it,
we'll see. But I would just want to say, Tim, I agree with you 100% in the sense that you give someone an incentive to go out and work and to build an estate. And if you take away that incentive, all of a sudden it has consequences,
yeah,
in
and
my opinion.
it seems to me that the estate tax, because we're not talking about a lot of money on an annualized basis that comes into the treasury through estate taxes, it's almost like it's a dog whistle to say we're going to make the rich pay their fair share. The only problem is, with all due respect, yeah, 13 million is a lot of money, but it's not like screw you money, right? So,
Yeah.
and again, when you think like we see it because we're on the front line working with successful business owners, successful people, and we see how hard they work. And, it's not just how hard they work to build their uh, business or their lifestyle, but it's how hard they work to try to maintain it as well. I had one of my first clients going back to 1986. He said something to me that I've remembered to this day. He said, having money or having wealth is like having teeth. And he said, when a baby is born, it's born without teeth. And then for the first year or two of its life, it works as hard as that baby's working as hard as it can to make those teeth or to have those teeth come out and so that they can use them. And once those teeth are there, that child has to work the rest of its life to keep those teeth.
Hmm.
And he said, that's how it is with wealth. Nobody, and this guy was a self-made guy, and he said, nobody handed me anything. I had opportunities. I took advantage of them. Some didn't pan out, and the ones that did put me where I am today, and I'm grateful for that. But nobody saw the blood and sweat and tears that had to go in and the anxiety when some of the things that I was trying to do didn't work out. And I bore that risk as well as the reward of the ones that were successful.
Yeah, and whose money is it, right? It's
Exactly.
yours. Don't you have the right to do what you want with that money? Isn't that a basic freedom that we have? I mean,
Ostensibly, you would think,
yeah, yeah,
but
yeah. And just to evolve the discussion a little bit, Tim. I know one of the things when you talk about protecting your assets. Um, I know another one of my dad's old sayings was, sometimes it's better to control money than to actually have it. And that gets into the old concept of a life insurance trust and what a great vehicle that is to protect your assets for future generations. If you control the money but you don't actually own it, then guess what? Your creditors can't get to it because it's not your money. And if you got divorced, for example, your ex can't get to it because it's not your money. And that's one of the key concepts we always used to try to get across as to how to use that exemption, that estate tax exemption, to put the money someplace else where it's going to continue to grow for the benefit of your family, and at the same time, it's protected. And you don't have to worry about what's going to happen to that money. You might have a child, and this is certainly not you, Olivia, but you might have a child who spends money like crazy and ends up spending the entire inheritance. With something like a life insurance trust, you have that double measure of protecting something like that, some assets that you have from being spent down unnecessarily. So
yeah. So, Bill, let me. Do we want to talk about Kugler? Because that was very relevant as I was getting into, the advanced planning uh, side of the financial services. I want to talk about the relevance of Kugler today.
yeah, thanks. Sure, I could talk all day about that. Listen, we built this company on the basic idea that we could take some really complicated estate planning concepts and make them understandable for not just an attorney, not just a financial advisor, but for the individual who had to make those decisions. And so we had a great system for explaining, for example, a grant to retain annuity trust or generation skipping transfers, these really advanced concepts where a lot of the people who talked about them didn't even understand them. But we had a way of making those relevant for people so that even the consumer could understand, the advanced consumer who had a decent amount of money could understand how these things work and how they could save money for people over the long run. And most of those concepts today, Tim, still apply. Now, obviously, one of the things that changed things for us, and I eventually started talking about Social Security, one of the things that changed for us was when the Tax Cuts and Jobs Act of 2017 went into effect. It didn't affect that many people. These ideas were not relevant to that many people anymore. So that's basically what changed it for us. But most of the concepts that we talked about still apply today.
Yeah. So just to be clear, the reason that those concepts, weren't as relevant today is because the Tax Cuts and Job Act raised the exemption so
Right.
much so that less and less people would have been affected by, to the point you made earlier. People would have, very few people have $27 million estates.
Yeah, that's right. And it still applies today, but that's the reason I think the percentage, Tim, is really small. It's less than 1% of people actually end up paying an estate tax. So we'll see what happens with the new law and see what happens. Again, the existing law is scheduled to expire at the end of 2025. If that happens, it's going to bring in more people, and we'll be waiting to jump back into the market very quickly with some ideas that might be
Yeah.
of relevance for a lot more people. So,
Well, you had mentioned earlier about, that your dad and built some ways to explain complicated concepts in a very simplistic way so that the layman could understand it. And that's where I got exposed and first met your dad. I met him at an MGRT conference, and I bought his software at the time, and it was very, very um, impactful for myself and the clients that I was dealing with. And I think that was the genius of what your dad brought to the table, and why I was so glad that you and I sort of reconnected, if you will, uh, with your current position at Security Mutual, because it sort of brought back a rush of interactions with your dad, and how beneficial his work had been for me and my business.
well, thank you, Tim. I'm going to try not to get emotional hearing you say that, but I appreciate that very, very much. I would just say that with the concepts that we did, it was always just a really basic idea that people could understand. One example I would give you was that, and you may be seeing this yourself, Tim. We always want to treat as when we get older and we become adults, we always want to treat our children equally. But sometimes being treating them equally and treating them fairly are two different needs because they're two different things because they're different individuals, and that's where it gets tricky. And if you own a business and one of your children is involved in the business, that adds this extra complication that you have to work out. So equal and fair are two different things, and that's where you got to navigate between those two. And very often, the solution to that equal versus fair problem is life insurance, because life insurance can help level things out a little bit more. And that's those are some of the kinds of concepts we used to talk about all the time.
Yeah.
So,
Not only that, but it also keeps it a little more private than having it in your will or like stuff going to your estate, because you could have a separate policy or a policy divided a certain way for those individual children, and they don't necessarily have to know what the other one's getting, which is,
right.
obviously a big deal.
Yeah, and again, the concept of a life insurance trust fits very well in there too, because it's managed outside of all the other issues you might have to deal with as well. So I agree 100%, Olivia. That's
Right,
true.
absolutely. And then it doesn't add to your estate either, right? The amount of money in your estate. So
Right.
hypothetically, so how do people, because I know a big issue if you were facing an estate tax burden, is having the liquidity to fund those estate taxes, right? So
Right.
when it comes to that, how should life insurance be positioned to help alleviate that burden without adding to the amount that's going to be paid in taxes?
Well, again, that gets back to the concept of third-party ownership. If it's owned by a trust, the trust, and there are estate taxes due, the trust can provide that money. Because keep in mind, for example, we used to talk a lot about what's called a joint life policy, a second to die life insurance policy. If you have a married couple, usually what happens is when the first spouse dies, the bulk of the assets go to the second spouse, and there's never an estate tax. There's what's called an unlimited gift or bequest to the surviving spouse. So there's no estate taxes due. But when that second spouse dies, then all of a sudden there may be an estate tax because that first spouse isn't there anymore. So um, with a second to die or survivorship life policy, it's on two lives, right? With the two spouses, and then it's payable when that second spouse dies. So if there is an estate tax, that money becomes available when it's needed for that estate tax, and not before and not after. So,
Bill, I'm glad you brought that up because my experience with survivorship, second to die life insurance has really not been that great. Meaning that, so let me explain. In general, the husband ran the business, would run the business, and they would, because of the size of their estate, they would purchase second to die insurance. And then in general, the life expectancy of a business owner is a full 5 years less than the average American. And
never heard that. Wow.
yeah,
Glad I
so,
sold my business.
Got your life back.
well, well, the point is that the husband in general will die before the wife, right? Because of genetics. Females have a longer life expectancy than males. And in general, the wife is usually a couple years younger than the husband. My point is that when the husband dies, there's usually a lack of income to the surviving spouse, and the surviving spouse can't afford to pay the premiums in general on that second to die policy, and consequently, the policy ends up either not being funded, reduced paid up, or lapsed. And that's the experience that I've seen over the 40 years in financial services. What I'm seeing is those policies aren't being paid out because of that issue. And I don't know what your experience is, but I bring that up because it's something that, I think in general, people should look at, or at least be considering a regular life insurance policy on the husband as well as a survivorship. What are your thoughts, Bill?
Yeah, I understand exactly what you're saying, Tim. It's almost like a hierarchy of needs, right? And listen, I think paying off or figuring out how to deal with an estate tax with a second to die policy is a priority for people who are in that financial situation. But I mean, obviously, the first priority and the reason people get life insurance when they're younger is why? To protect their spouse, to protect their children when the money is needed. That's the first priority, is to make sure they have enough money to survive if the business owner dies. So that's number one. Number two is that a second to die estate planning policy, which is more of a pure financial play, a cheaper way to deal with this estate tax issue in the future. So that's something. So I think they're two separate considerations, but I agree with you in the sense that I think the first priority is to make sure that your survivors are going to be okay with the rest of their lives if you're not there anymore. This is a second priority to a higher income individual who already has that taken care of. And I guess I probably should have clarified that, but that's really where this type of plan belongs.
Yeah, absolutely. And again, I understand the logic of it, but the practice of it, what people didn't count on was the husband dying not too long after the financial crisis when their estate got cut, by 40%, assuming they sold their business and they had their money invested and they got, their investable assets got cut by 40-50%. And now they've got, they're looking at the specter of possibly running out of money and having to fund a life insurance premium.
Yeah. Yeah, and then under those circumstances, I wouldn't blame anybody for not funding that life insurance premium
Yeah.
or delaying it if you can. So this is where a professional like you and Olivia can really be of value to someone to try and navigate that and figure out the best way to deal with it and keep everything together. So,
Now, at the end of the
And-
day, it all comes back to that creativity, the ability to solve problems for different situations, and no one product is good or bad. It's how it's used, how it's applied, how it's funded, and how it's maintained over the lifetime of a client, right? And as circumstances evolved as well.
oh, absolutely. And another thing that I've been seeing a lot of lately is clients who some of my dad's old clients who live well into their 90s, and all of a sudden the life insurance that they had becomes more difficult to fund. And it might have been guaranteed to age 95. What happens if you get past age 95? And that's another area where serious financial professionals like yourselves can navigate that and try to nip that in the bud if you can, a couple of years ahead of the looming disaster. So,
Yeah, exactly. And we've seen that. We've seen uh, some really horrific situations that have emanated from, you know, people not planning on living as long as they did, and now
yeah,
they have issues that, longevity it increases the risk of all the other risks that are on the table.
yeah,
So
and one of the keys is what Olivia said before about funding and about maintaining those policies. We had a client where he had not properly funded his life insurance policy, and the way the policy worked, it was what's called a universal life policy. The way the policy worked was that if he reaches age 95, he gets the cash value of the policy. He doesn't get the death benefit, and the cash value was almost zero. Um, and I don't know how to say this because it's going to sound really kind of rude and awkward, but the guy died when he was 94 and a half, and that it could have been worse. Okay, if he had made it to 95, that policy would have essentially disappeared. But so you really have to be careful, and you have to make sure you're addressing this along the way to make sure it's properly funded.
Bill, that is such a great point because we have seen a lot lately of people who have purchased universal life policies specifically for estate planning or business planning purposes. And we have one case now where the woman is 91 years old and a $2 million death benefit right now, if she lives to 92, is going to be cut to 800,000, and if she lives to 93, it'll be cut to 200,000, and if she lives beyond 93, it's zero.
Yeah,
And I think that's a classic situation where the product doesn't fit the concept or the solution. The product was the universal life product was they thought a permanent permanent solution but it really isn't. And I think that that onus falls on the agent for literally selling an inferior product.
Yeah, I mean, I think people always assumed that whatever interest rate they were paying back then, back let's say in the early 90s, was going to continue. They had no idea that the bottom was going to fall out of interest rates, and that the interest rates on these policies, even today, is not what they originally anticipated. And as a result of that, there's not as much money inside the policy, and that's
Right.
what made it work.
And the crime of it is that they could have purchased the right product for not much more or probably the same as what they paid for the inferior product, but it wasn't proposed to them.
Yeah.
Yeah, and at the end of the day, it does come down to making sure you're educated, you're making informed decisions, because those universal life policies do end up transferring a portion of the risk, like we saw in that example, to the insured, the policy owner. And with that, it gives insurance a bad name, right? Because they hear about these different experiences of people who had permanent insurance, quote unquote, that wasn't written to deliver what they thought they were going to get. And I think it's a lack of education sometimes on the agent side, especially because they're the one who is communicating what to expect to the client.
Mm. Yeah, and I would add to that too, Olivia. I think when those policies are presented, the first issue people want to look at is how much does it cost, and they are likely to take the cheapest initial premium price without realizing what the implications that might have in the future. So that's the rationale that goes into it, and that's why we end up in situations like this, is because of the cheaper premium cost initially. So
Absolutely, and a lot of times they're presented as this new shiny thing, and they illustrate so much better than the whole life policies. So it's like, okay, as the client, it seems like a no brainer. I want this new shiny thing that's going to perform better than this old dinosaur. And what happens is it doesn't actually end up happening that way for the client. And you don't find out you're making those mistakes until so far down the line and so much money in the policy that you're like, oh gosh, what did I do? How do I fix it? And hopefully there's enough cash in there where you're able to resolve it, and hopefully you have enough health left in you to resolve it with a better, more stable, longer lasting policy with guarantees.
And that's a great point, Olivia, because those policies aren't necessarily bad, but they definitely need to be monitored everywhere along the way. And I think that's where what we're seeing is that nobody's watching it. It's like nobody's monitoring it, nobody's testing it, nobody's making sure that what they wanted to have happen is going to happen. But the problem is, again, nobody's overseeing those policies tend to be a little bit more, tend to require a little bit more checking and testing and monitoring along the way. And most agents aren't willing to do that.
Well, as the agent, from the agent side, that testing and monitoring is going to be, okay, I sold you this policy. I said it's going to cost this amount of money per year to get you this amount of death benefit, this amount of cash value. But this year, we need more money to achieve that, right? Who wants to have that conversation?
Well, then the answer
yeah,
is don't sell it. Which, by the way, we don't. Our clients never have that problem with stuff that we sell because we sell the guarantees. We do worst case scenario planning when we're making our recommendations, and that's, I think, a huge difference. So, Bill, thank you so much for joining us on our podcast the second time. I want you to know you're an elite company because I think you might only be the second or third person that we've had back for a second round. So, and we're hoping to have you back in the future for sure.
Well, listen, thanks to both of you, and that I really would love to do this again because there's a lot more stuff that we can talk about, uh, not just related to insurance, but related to other financial concepts as well. So I would, I'm thrilled and honored to be part of this and working with both of you. So thank you for the opportunity.
Thanks, Bill. We'll see you next time in that case.
Okay.
Bill
Bye.
Rinaldi, thank you.